Good afternoon, ladies and gentlemen. I always think of the first session after lunch as being the siesta session. We've all had a good feed, so hopefully I won't put you to sleep and hopefully I won't fall asleep while I'm talking. As Ian said, my presentation, it's a little bit different to what you've been hearing earlier in the day. You've been hearing directly from some of the listed investment companies and trusts and hearing about their investing strategies, what they invest in. I'm going to talk to you now about how you can actually build a well-diversified portfolio by using solely or almost wholly listed investment companies and trusts. You've seen lots of these today, I'm sure. All this says basically is that this presentation is research. It's not advice. If you do wish to act on anything that you hear or see presented here this afternoon in this presentation, please see your financial advisor beforehand. I won't dwell too much on this slide. I think you've heard from Ian earlier this morning and some of the other presenters, most of the themes coming from this slide. I guess the main theme that I'd like you to take away from this slide, though, is that there are a lot of listed investment companies and trusts out there. The number keeps growing. And that there are a diverse range of strategies which does make it easy for you to build a portfolio constructed entirely of listed investment companies and trusts, a well-diversified, well-balanced portfolio. This just looks at the diverse range of strategies or asset classes that you can invest in by investing in listed investment companies and trusts. As you would expect in the Australian market, the largest number in Australian shares strategies, mid and small, large cap. We've got a good number in international, and that keeps growing. That's grown quite a bit. There's a diverse range of strategies there, and I'll come back and talk about those in a bit more detail. And then there are a number of alternative fixed income and alternative strategies that you can invest in. And as we go through how to build a portfolio, we'll talk a little bit more about those strategies. So let's start constructing a listed investment company or listed investment trust portfolio. For most Australian investors, the core component or the basic building blocks of their portfolio would be Australian large caps. This is where you've got the big banks, the Telstras, the Woolworths, etc. And most Australian investors value the fully franked dividends from these companies. So if you're looking to build a portfolio with listed investment companies, there are 19 LICs and LITs that invest in this space. And again, within that space, you've got a diverse range of listed investment companies and trusts. The majority are internally managed. You've got the large, long-standing listed investment companies such as AFIC, Argo, Milton, BKI, Whitefield, just to name a few of them. But there's also a number of smaller LICs and LITs that have actually come on over the past few years. Most of them are externally managed, so you have an external fund manager sitting there constructing the portfolio and charging the listed investment company a fee for managing that portfolio. If you look at the larger, long-standing LICs like AFIC and Argo, etc., they tend to have pretty large, well-balanced portfolios themselves in that they tend to invest right across the market. Although given the predominance of large caps in our market and just the sheer market cap of them, they tend to be very heavily weighted towards large cap stocks. Some of the newer LICs that have come on over the past few years tend to be more concentrated. They may not have as many stocks in their portfolio as an AFIC or an Argo. And the managers construct those portfolios based on their fundamental research processes and their high conviction views on individual stocks. There are also a number of specialist LICs in that space. We heard about Whitefield this morning being the oldest listed investment company in Australia. Whitefield invests purely in industrials, so they don't invest in resources. So if you're not interested in investing in the resources sector, Whitefield is a pure industrial focus. There are also a number of LICs that focus on harvesting dividends. They have strategies to maximise their dividend income and take advantage of franking credits, and that's of benefit, presuming that Mr Shorten and Mr Bowen don't take those franking credits back from us. And there's a few LICs also that try and supplement their income by writing options. And Livewire, which is run by the same investment team that run Australian Foundation Investment Company, is one of those listed investment companies. So we've built the core component of our portfolio with Australian large caps. How about we add a little bit of growth and diversification with some small caps? Small caps tend to be higher growth companies than large caps, particularly if you get a small cap that's in an industry which is a nascent industry, such as in technology. And a lot of small caps will grow into large caps. If you think back 20 years, Cochlear, CSL, they were small cap businesses. CSL listed with a market cap of 230 million. Cochlear, I think, was 250 million. So there's a lot more opportunity for growth and also diversification by investing in the small cap space. There are 27 LICs and LITs that invest in small and mid-cap strategies. Most of them are externally managed, so that you've got an external manager there managing that portfolio based on their research processes and their convictions. There's quite a range of exposures that you can also get in that space. There are a couple of LICs, QVE Equities is one. There's also Contango Income Generator that specifically invest in mid-caps. So just outside that top 20 or 30, they'll invest in the next 50, 100. You've also got a lot of LICs that invest in the small cap space, and then there are those that invest in the really small companies such as micro caps. And again, there are specialist focuses within the small cap space. You heard from Westoz this morning. They invest purely in Western Australian companies and in the resources space in particular. So we've put together the Australian component of our portfolios. We've got the Aussie large caps, we've got the mid and small caps. How about we put some international exposure into that portfolio? I think this is an area where Australian portfolios tend to be underweight, and there's understandable reasons for that too. I think a lot of us chase the high yield of Australian companies, but in my view, we should all have a reasonable component of international shares in our portfolio. And there are 31 listed investment companies and trusts for you to actually choose from and add international exposure to your portfolios. Most of these are externally managed, so again, you have an external fund manager who's sitting there putting together portfolios based on their fundamental research processes. There are a number of LICs that have blended portfolios too. I think you heard from Cadence, you heard from Cadence this morning. Cadence invests in both domestic shares and international shares. Then you heard from Magellan this morning. Magellan tends to focus on the large cap shares. They've got a lot of the big technology companies from the US in their portfolio. And then you also heard from Bill from Elliston this morning. And their particular market niche is in the mid and small caps, and I think that's a particularly exciting area too. So, and then I think there's 4 or 5 listed investment companies that invest in Asian companies, stocks listed in the Asian markets. So I think from that you can see there's quite a number of different strategies within the international space that you can invest in by buying listed investment companies. So how about we add some fixed income to our portfolio? Fixed income tends to generate more regular cash flows. This is a fairly new area of the market. It really opened up with the listing of MCP Income, which was listed by Metrics Credit Partners last year. There are 3 listed investment trusts in that space at the moment, and you heard from Qualitas this morning, which has an offer or a prospectus lodged and an offer opening shortly, next week, and they'll be the 4th player in that space. The 4 of them, they're in different areas of the fixed income market. Qualitas, who you heard from this morning, lends for commercial real estate. There's Griffin. Griffin lends for residential-backed mortgages, and I think you heard from them this morning as well. Metrics, or MCP, invests in corporate lending, and so there is a diverse range of strategies that you can access there in the fixed income space. It is an area where there are different risks, and credit risk is primarily the main risk. Make sure that you understand those risks before investing in that space. Now, how about we add a little bit of spice to the portfolio with some alternatives? This is not an area that may suit all investors. It is higher risk. Cash flows can be lumpy, and returns may take time to emerge. So make sure before you invest in alternatives that you do understand the risks and that you're happy that it is suitable for your portfolio. But there's 19 LICs and LITs in this space, and they cover quite a broad range of strategies and asset classes. You've got a number of private equity LICs. There's one that invests in technology, Bailador Technology investment. There's a few that look at absolute returns and have long-short strategies. And again, there are different risks associated with long-short strategies. Make sure you understand those risks. So hopefully I've demonstrated to you that there are a lot of different asset classes there within the listed investment company and listed investment trust space, and that you can put together a well-diversified, well-balanced portfolio. Now, I deliberately haven't spoken about numbers or proportions that you should put into each categories. I think that really depends on you. It depends on your own needs, your own risk profile. But I think what you can see is that by buying perhaps 2 or 3 listed investment companies or trusts in each of these asset classes, that you can build up a portfolio of probably 10 to 15 LICs or LITs, and you've got well-diversified exposure, a broad range of investment strategies, and that should meet your needs. If you already hold a portfolio of, say, large caps, then you probably wouldn't go and buy large cap listed investment companies, but you could supplement your portfolio by buying LICs in the mid-small cap space or international shares. So before I finish, just a few tips on constructing the portfolio. As I said, you should really just blend the portfolio to suit your own requirements. For instance, if you're an income investor, then you'd probably put a larger component of Aussie large cap shares in your portfolio, because this is where the fully franked income comes from. If you're a conservative investor, you might opt to put a well-balanced or well-diversified international exposure into your portfolio, rather than going and buying a few LICs that invest in the Asian sector of the market, because that is a more volatile sector of the market. It's also important not to double up on your exposures. So as I said before, if you already hold a portfolio of the banks, Telstra, Woolworths, you wouldn't go and buy an AFIC because you've already got exposure to the sector of the market that they are in. Also, make sure that you do understand well all the specific risks of the particular asset class that you're investing in, and particularly to make sure you understand the risks associated with each individual investment company that you're looking at. And again, I'd just like to reiterate that alternatives and private equity are generally higher risk and that returns can be lumpy. So a few tips on, this is what we look at when we research the LICs. So a few tips for you on how to go about researching the listed investment companies. Probably the first thing we look at is the manager. And in particular, we look at the experience of the investment team. Does the manager have experience in the particular asset class that they're investing in? So as an example, if you're buying shares in a small cap LIC, then you would expect that the management team has experience and proven performance, proven track record in small cap investing. You'd look at their track record and say, have they delivered the returns? If they're investing in small caps, you'd expect that at least they would match the small cap index or the small cap benchmark. Make sure they've got proven processes in place too. Do they have proper processes for selecting stocks, proper fundamental evaluation techniques? We wouldn't be interested in a manager that wakes up in the morning and says, okay, I might put some Westpac in the portfolio today. Oh no, I'll sell BHP. That's not a proven investment process. We want defined, well-structured processes for selecting stocks and constructing a portfolio. Has the manager been meeting its objectives? And again, just looking back at the small cap example, if you're investing in a small cap listed investment company and the manager says that his objective is to beat the benchmark by 1%, have a look and see if he's actually been doing that. If he hasn't, then he's not delivering on what he's told you that he will be expected to do. Fee structures. I guess the question you have to ask yourself there, are the fee structures reasonable? We tend to see fees of around 1% for the externally managed listed investment companies and trusts. Anything higher than that we would consider to be on the higher side. But be aware though that fee structures will vary depending on the complexity of the strategy. So if you're investing in a strategy which is complex and requires a lot more thought and processes to construct the portfolio, then you might expect to see a higher fee for such a strategy. Some of the externally managed LICs and LITs also have benchmarks for performance fees. We see performance fees range normally between 10 to 20% when there are performance fees in place. 20 definitely is at the higher end. Also, look at the benchmark that they are using to reward themselves with a performance fee. Again, going back to our small cap example, if you're investing in a small cap LIC, you would expect that their benchmark for performance fees would be the small cap index. If they're using something else, such as the RBA cash rate, you'd have to say to yourself, that's not really appropriate. We also, for listed investment companies, whether it's a listed company, you have a board in place. We look at the structure of the board. Our preference is to see independent boards, but we acknowledge that that is not always the case because a lot of the managers, they'll put their own representatives on the board. So I guess the things that you have to look at and ask yourself, look at the background to the individual directors and say, are they people of integrity? Do we think that they will always act in our interests and as shareholders in the listed investment company? If you can't convince yourself of that, then you probably should steer clear. Finally, true to name, what I mean by this is the manager doing what it said it would do? So again, going back to our small cap example, if the manager has said that it is going to invest in small caps, you buy it, you put it into your portfolio because you want that small cap exposure. If you suddenly find that the manager is loading Westpac and BHP, Telstra into that portfolio, then they've deviated from what they've told you they will do. They're not really a small cap LIC any longer, and you invested in them because you want that small cap exposure. So you would have to say to yourself, should I remain in this LIC? A few more tips. We heard this morning, I think Jeff Wilson spoke about how listed investment companies and trusts can trade at discounts and premium to NTA. This can be good and bad. If you're in a listed investment company that's trading at a big premium, then you might wish to get out of it and capitalise on that premium. So what I'm saying here too is that you shouldn't overpay, and I think Jeff Wilson said that in his presentation this morning when he said he wouldn't buy his own LICs because they're too expensive. If you see a LIC which is trading at a 20% premium to its net asset backing, you really wouldn't buy it. You wouldn't pay 20%. Also, if there are LICs that are trading at big discounts to the NTA, you might think, okay, I've got a bargain here, and hopefully over time you will have. But there are reasons that LICs can trade at discounts. Often it's because of underperformance, perennial underperformance. So you have to ask yourself beforehand, will that discount disappear? And what are the catalysts for that discount to disappear? If you can't find any or think of any, then maybe you wouldn't buy that LIC. It's also important to make sure that there's adequate market liquidity. Are there sufficient trading volumes in the stock? If you're wanting to get in and out of the stock quickly, but it doesn't trade frequently or it trades irregularly, then that's something just to be aware of. We've found, particularly with a number of small LICs with very small portfolios, that they can be, because they're subscale, there's not a lot of interest and they don't trade frequently. So just to conclude, I think you've probably heard a number of people talk today about the need to have a well-diversified portfolio, how it is essential that you should have diversification. Hopefully I've shown you that you can do this pretty easily with listed investment companies and trusts. You should also make sure that you do your own research before investing in any particular asset class or any particular listed investment company or trust. As Ian said, we do research. We do a monthly report and we also do a quarterly report. We publish those reports on Livewire. I think if you ask the Livewire desk, I'm sure they'll be able to tell you how to access them. Yeah, just to finish off, make sure that you do construct the portfolio to meet your own needs and your own investing style. And as with any investment portfolio, make sure that you do a regular review. Thank you, ladies and gentlemen. Thank you, Ian.